Thank you very much, Farkas, for inviting me to speak today to Condor Global. And I'm very glad to be here. Let me say I'm going to share my screen. And so I want to just check, are you seeing the correct screen?
Yes, it is correct, Lorraine.
Great, that's really helpful. Thank you so much. I'm going to talk about the global minimum tax today, or what we've been calling GLOBE, which is part of Pillar 2. And I've titled my talk, A Bridge Between the Worldwide and Territorial Tax Regimes. And I'm going to address the following research question. What is the GMT, the global minimum tax? And if it does get adopted, how will it likely affect OECD countries and developing countries? And I'm going to look at this in 4 steps. I'm going to look at how multinational profits are taxed, an overview of the GLOBE proposal, and then I'm going to talk about how I think that will change the international tax regime if it's adopted, and then talk about the expected effects. Let me say, as a background, I have a PhD in economics. Fields are public finance, international economics, and international business. I've been primarily a professor in US and Canadian universities, and most of my work is on transfer pricing and international tax, and on the strategies and structures of multinationals. And I'm a new appointee in June to the UN Subcommittee on Transfer Pricing. The reason why I start this as introductory remarks is the way I come at the question of the global minimum taxes as an economist from the fields of international trade and of public finance. There's been a huge amount written on this topic, a lot of it primarily by lawyers and by accountants, and I'm neither. So you'll find my talk, I think, a little bit different maybe than some of the other ones because my background is in economics. So let me start with the very first of these subjects, which is how multinational profits are taxed. And I'm going to start by talking about this from the perspective of thinking from public finance and international trade theory about what economists and political scientists call regimes. Then I'm going to talk a little bit about the current international tax regime, and I'm going to talk about worldwide and territorial taxes, and then move from there into base erosion and profit shifting. So just a quick overview. International regime theory is a theory that's been around since about 1980, so it's now over 40 years old, well known in political science, and it basically argues that there are international governance structures that are designed to manage interdependencies among countries. They could be either coordination regimes or cooperation regimes, but the idea is that governments get together and they agree to work together in a particular area where there are spillovers and interdependencies between countries. Regimes are designed to set up relationships among governments in a particular area, like the WTO regime or GATT regime, for example, the regime in international money, the regime in international finance, law of the sea, for example. And I have argued for a very long time that there's also one in tax, the international tax regime. If you think about it that way, regime theory is helpful for understanding how the international tax system works worldwide and how countries interact themselves as part of that regime. Typically, regimes are set up in a hierarchy with principles, norms, rules, and procedures. Principles are general overall principles like equity and neutrality and transparency. Norms are standards of behavior, things that you should do, things that you should not do. The rules are the details filled in with all those regulations about how to actually do this. And then the procedures are dispute settlement. How do we solve disputes? All right. So if we think about the current international tax regime, the purpose, as we know, is to prevent double taxation or under taxation of the income of multinationals that they earn all over the world, their global profits. There are principles behind this based on equity, neutrality, transparency, feasibility, simplicity, and other potential ones like national treatment, for example, that affect how we think about the norms and standards of behavior. The key norms, I think, are the separate entity principle. That means in every part of the multinational group, every incorporated entity, every permanent establishment is a standalone separate entity. Countries can tax up to their water's edge. In other words, the source country where a subsidiary is located has the right to tax all the multinationals in that jurisdiction up to the water's edge of that country. The arm's length principle is used to allocate profits across country when there's cross-border transactions between related parties that have to be priced. And then also in these norms are a list of who has the right to tax when and how in general. Now, the rules are all those details. The details on nexus, what is a permanent establishment, what the tax rates are, how we define the base. Do we tax on an accrual basis? Do we tax on a deferral basis? And then there are our double tax treaties, all the auditing, all the dispute settlement procedures, exchange of information. So it's actually very helpful to think about international tax in this idea is there's a purpose behind it. There are principles, norms, rules, and procedures that govern it. It's not that it's fixed, and it's not necessarily that it's all formal. Parts of it are formal, and it does evolve and change over time. If you look at the current international tax regime, basically what it does is it'll say which kinds of profits have the right to be taxed where. Business profits, in other words, are typically taxed by the residence country. Residence country is the home country where the owners of the firm live, as defined by where the firm is incorporated, where the seat of management and control is. Source countries are where the subsidiaries and the permanent establishments are located, and they have the right to tax the income that is generated in that area. The source country can only tax if there's sufficient nexus. In other words, if there is a subsidiary incorporated there, or if there is a permanent establishment there. The residence country, under the current rules, has the right to tax worldwide income. In other words, tax income earned in the home country where the parent firm resides, but the country can also tax the worldwide income of all of those foreign affiliates. Typically, what happens is you have this problem, therefore, of double taxation. If both the residence country and the source country can tax, the multinational could be double taxed. And so the rules say that the residence country must make tax room. In other words, it must offer a foreign credit for the source country tax, or it may exempt the foreign source country tax from being taxed at home. Now, there are different kinds of rules for other kinds of business income. So royalties and management fees, service payments, for example, are treated differently, again, under the rules. Typically, they're allocated to the residence country, and the source country levies a withholding tax on the way out. And then bilateral tax treaties are used to handle disputes. If you look at the system, historically, we went back, say, to the 1930s, most countries had a worldwide tax. In other words, the residence country taxed the worldwide profits of its multinationals on an accrual basis. Somewhere along the line, there was a switch moving from accrual to deferral. Deferral meant that offshore profits of active business income simply were not taxed. Countries often, though, had rules on passive income. And what is called in Canada would be called FAPI income. In the United States would be called Subpart F. And worldwide, the general term is CFC rules, Controlled Foreign Corporation rules. So the system has been pretty much for a long time one where there was worldwide taxation, so the residence country could tax on a worldwide basis. But what it did is it exempted active business income from tax. Passive income was taxed under CFC, Controlled Foreign Corporation rules. Most residence countries allowed the profits that were kept offshore to be deferred. And economists a long time ago in the early 1980s proved that deferral was basically the same as exemption. If a multinational could keep its foreign source income offshore and never bring it home, in effect, that was as if it was completely exempting it. Now, starting with a few countries, they decided to move from worldwide taxation to territorial. And the reasons were pretty straightforward, I think. Most country tax rates were reasonably close. So if you were going to tax on a worldwide basis, but you were going to give a foreign tax credit, you weren't going to collect much tax anyway. Administratively, it's high cost to do this. You need to find out where all the foreign source income is. You need to check which kinds of taxes are creditable. You need to do the credits. The multinational has to do this. The tax authority, the residence tax authority has to do this, and there could be disputes. So what happened is many countries moved to a territorial system fairly early on because they weren't making much money from it, and it was administratively quite complex to matter. So what we have, they would move now to simply exempting foreign source income from tax. We may have now a bit of a hybrid scheme where basically active business income is exempted or deferred, which is the same as exemption basically, and passive income, if there are CFT rules, may be taxed. Now, let's have a look at what we mean if they have worldwide taxes and you tax on an accrual basis with a foreign tax credit. So assume a country has the residence country has a 30% tax rate, and you can see the tax rates in this picture, and these source countries are 20, 10, and 25, and other rates, one above 30 here. So there are tax gaps where some of the rates are below 30%. So in effect, what happens on a worldwide system is a residence country offers a de facto umbrella by saying, we are going to put a foreign tax credit on, we're going to tax you up to 30%, but we will give you a foreign tax credit up to 30%. The optimum policy in that case is for source countries to basically cluster just at or under the residence rate. That means the tax rates become very close together. And as I said, that's how it first started when we started with the worldwide tax system. Rates were much more clustered. When countries started moving to a territorial system, the umbrella went away. When the umbrella goes away, the effective rate that governs where foreign direct investment made is the source country rate, not the residence country rate, but the source country rate. And so what happens is foreign direct investment could be attracted into countries where tax rates are low. So you see here the exacerbation of the differences in tax rates across countries, which encourages tax competition and a race to the bottom. And that, of course, is what we've seen. Here's a map that was prepared, all right, by the Tax Foundation that shows the shift from worldwide to territorial tax system. On the left are the number of countries with a worldwide system, and you could see basically about 40 countries back in the late 1800s. And now very, very few countries are on a worldwide tax system. Even the US, with the Tax Cut and Jobs Act, moved to a quasi-territorial system here, with the exception of the piece that's on GILTI, and I'll talk about that afterwards. Now, as we saw countries move to territorial tax systems, look what happens. You see a big rise in global profit shifting. And the question is that shift to territorial systems part of the reason for the rise in global profit shifting? This is a brand new study by Weir and Zuckman that was published last week in the NBER, and the link is here if you want to see the story yourself. On the list shows the percent of multinational profits reported in havens, and that's now up to 40% of all M&E profits are reported in tax havens. And on the right is showing you the amount of profits that are being lost due to profit shifting, and it's about 10% of the total profits. I want to spend a little bit of time on this slide saying, what's the reason? Why are we seeing such a huge increase in global profit shifting? I would argue basically since the year 2000, since the millennium. Movements to a territorial system mean inward foreign direct investment responds to source rules. The umbrella that worldwide taxation gave is gone. That leads to wider tax differences across countries, and base erosion of profit shifting activities were exacerbated by this. Foreign source income was not taxed by the residence country. Where there was deferral, there was just a big overhang and the money was kept offshore. And in the United States, one of the big problems that is still there are the US check the box rules. The US does have CFC rules, subpart F, but they're been eviscerated by check the box. The competition for inward foreign direct investment led to a large rise in the number of tax havens that set statutory corporate income tax rates close to zero, and a large rise in the number of source countries offering tax preferences to encourage inward foreign direct investment. What we got were what was called locational tournaments or beauty contests, as source countries fought to attract inward FDI by offering more and larger tax preferences. This was exacerbated because countries didn't share much information. The lack of information and lack of coordination among tax authorities put the bargaining power on the side of the multinationals, not on the side of the tax authorities. These loopholes in the international tax system encouraged the development of very sophisticated tax avoidance strategies. Avoiding permanent establishments by setting up commissionaire structures, for example, exploiting mismatch relationships. We all know about Ireland, and Ireland and its two-headed definitions of whether a subsidiary was in Ireland or not. The problems of equity, defining what's equity versus debt, when we know that debt is tax deductible and equity is not. Abuse of treaties. The Dutch sandwich is a well-known example on a way to reduce withholding taxes within the European Union. And there was aggressive transfer pricing, particularly on interest charges and management fees, and a lot of IP migration outside of where the IP was originally developed and shifted off to tax havens and investment hubs. Now, BEPS 1. The OECD's move on BEPS 1, and if you look at the action items, here's the 15 action items, you can cluster those action items related to these loopholes in the international tax regime and related to the need for more information and coordination sharing. And so as BEPS 1 has been implemented by the multilateral investment instrument, what's been happening is that more and more of these loopholes have been being closed, and the incentives for base erosion and profit shifting have been going down. There was still clearly within the OECD, though, a perception that BEPS 1 wasn't enough. Action item 1 on the digital economy had been left to be handled, and the perception there were still loopholes in the tax regime. So let me move quickly now to talk about the global minimum tax. And I'm sure most of you are familiar with it, so I'm going to go through this part quite quickly. First of all, what you see here is some of the reports that the OECD and the Inclusive Framework have published that are related to the minimum tax and the various topics in here. I have listed all of the various publications related to global minimum tax. They're all clickable. And so if you have the PowerPoint, you can go actually to these on the timeline. The purpose of the global minimum tax was to ensure that large multinationals paid a minimum tax regardless of where the ultimate parent entity, the UPE, or the what are called constituent entities, the subsidiaries of permanent establishments. And there were two mechanisms, what are called the GLOBE rules, IIR and UTPR, income inclusion, and what was called the undertax payment rule. And then the second mechanism was the subject to tax, the STTR. I am going to talk about the GLOBE rules today and not the subject to tax. Right, in all the work, there's a layout of how this is done. You have to define the scope. In other words, which ones are the constituent entities. You've got to figure out what GLOBE income is. You've got to figure out what covered taxes are, calculate what the effective GLOBE tax rate is, and what is needed to the top-up tax to get it to 15% if it's below 15%. And then the question is, who gets to collect that? So the scope is large multinationals with revenues greater than 750 million euros. And you can see I'm going to go through here. The calculation of the tax, basically, the rate is simply to calculate the covered taxes and divide by the GLOBE income. So it gives you an average effective rate here. Top-up tax gets you to 15%. And again, this is a picture computation from the OECD. That, and then the top-up tax is that multiplied by the excess profit. There is, and I do think this is important to talk about, a carve out for tangible assets and payroll, so that if the carve out is allowed, that reduces the amount of top-up tax that is due. All right, who gets to collect the top-up tax? The way it was originally set up was the income inclusion rule was the dominant rule, and that went to residence countries. So if you go back to 2021, when the original pillar blueprints were released and the economic impact assessment was done, the calculation for GLOBE was done on the assumption that the residence countries were going to collect the money. So I think many cases, the residence country thought this was going to be primary benefit to them. And when I wrote my first paper on this in late 2020 on GLOBE, I said, what happened to the source countries? The source countries should have the first right to tax. That's the first crack principle. And that was then realized. What happened was the countries then recognized that if you could have a source-based tax, maybe I'll go down to that one. Let me come back to that. So we have the income inclusion rule with the residence country getting it first. And that was the original projection that residence countries were primarily going to benefit from this. And if they didn't collect the tax, we had this backstop called the undertax payments rule, the UTPR. And it basically said source jurisdictions could capture the tax, and nothing was there about how this was going to be done until a year ago, next month. In other words, in December 2021, GLOBE rules were published, and that was the first time rules were published on the UTPR. By the way, the title got dropped. I mean, nobody calls it the undertax payment rule now. It's the UTPR. And in everything the OECD has published, it's just become UTPR, not undertax payments rule. The UTPR, added in December 21, established how that money would be allocated. It said basically a group of source jurisdictions could claim the money if the residence jurisdiction didn't exercise its right to tax under the income inclusion rule. And it would be allocated among them based on an equal weighted, a 50-50, two-factor formula based on employees and capital, property, plant, and equipment, in other words. In other words, we had global formulary apportionment for source countries that allowed them to take the money, the top-up tax from the residence country, should the residence country not exercise the income inclusion rule. All right. The rest of this, very simply, is, as you know, the OECD made a decision that there did not need to be a multilateral treaty. It would be a quote-unquote common approach. Individual countries could choose how they did this themselves. GLOBE was supposed to allow in guilty on the United States to be grandfathered here. And then the question was which ones would join and not join. The problems between GLOBE and guilty have been discussed everywhere. The Build Back Better Act that President Biden hoped to get passed would have made guilty much more consistent with GLOBE. It did not pass. We now have a Republican-controlled Congress, House of Representatives. And so the real question is what will happen in guilty? Will there be an attempt to make it better fit GLOBE or not? And there's been a lot of speculation if it does or it doesn't, what the impact will be. Okay, let me shift now to talk about the tax impacts. What are the likely expected effects to be here? And I want to talk about 4. First, the ranking of who gets the top-up tax is really very important for the results. Second, I want to talk about what the implications would be for that principles, norms, rules, and procedures international tax regime I started with. Third, I want to talk about BEPS, base erosion and profit shifting, and what the impacts will be for location. And lastly, I want to talk to tax preferences. So let's start with how the ranking orders. So here's where the first crack principle comes in and really matters. In the changes that have been made to GLOBE over the last year or so, there was a recognition, which I had first raised in December 2020, I had raised that what you needed to do is source countries should have the first right to tax. That's where the income, the foreign source income is earned. They should be able to levy a tax on that. And therefore, that should take precedence and have a foreign tax credit against the income inclusion rule. This now has the odd name of qualified domestic minimum top-up tax, QDMTT. It's quite a mouthful to say. What it means is if a country's own domestic corporate income tax is, shall we say, 12%, and is taxing foreign multinationals in that country and domestic firms at 12%, the country could levy a domestic qualified minimum top-up tax of 3% only on the foreign multinationals that are in that jurisdiction and meet the top-up tax, and it would all be fully creditable against the IIR. What that means then is you would reinstate, as I'll talk about, the first crack principle up to the level of 15%. Now, if the residence country doesn't tax it using the IIR and the source country doesn't levy one of these domestic qualified minimum top-up taxes, then all those other countries in the multinational network that are sitting out there, all those other source countries have the free-for-all, basically, to each get a piece of that untouched pie, that top-up tax, and it will be allocated among them based, as I said, on formulary apportionment. So what would happen here, as I said, the income inclusion rule, the red boxes go to the residence country. Under a qualified domestic minimum top-up tax, the red boxes go to the source country where the foreign source income is earned. And they could either do it through a domestic tax or add a top-up tax that only applies to that foreign source income of foreign MNEs. And then lastly, if the residence doesn't do it and the specific source country doesn't do it, all those other source countries out there have the opportunity in a free-for-all to go after those red boxes of the top-up tax. Now, one of the things that was realized in setting up GLOBE was what do you do if the residence country itself has a tax rate that's less than 15%? Well, clearly the source country can't get at it, but clearly those other source countries might potentially be able to get at it through the undertax payments rule, the UTPR. All of a sudden, the big residence countries recognize, oh my goodness, if we are subsidizing some of our multinationals at home with tax preferences so their rate is below 15%, a whole group of other countries that have nothing to do with how that income was generated or how it was earned or the no transactions have the ability under this UTPR to go after that tax. I think this was totally unexpected. And when it was first discussed, and I think many of the US Congress members were horrified to realize that the preferences that their own multinationals were getting inside the US might potentially be taken away through top-up taxes levied by subsidiaries. Recognize what I'm saying. We typically think of the parent taxing on a worldwide basis and it has the right to tax foreign source income. We're now flipping the system and saying a group of the countries where the subsidiaries and branches are located have the right to go back and tax the home country, the residence country. This was, I think, a very topsy-turvy world. So let's talk about the impacts here. The impacts on the current international tax regime. If this goes through, the GLOBE will put a 15% floor on profits earned both in residence and in source countries. The IIR will act as a tax umbrella, encouraging source countries to set their rates up to 15%. And therefore, the source countries will be able to get those profits first that would have otherwise gone to the residence country. And there'll be an incentive to do that because if the source countries don't tax it, the residence country will under IIR. This means the first crack principle has been reinstated, the one that was lost, I said, by the move to a territorial system and by an eviscerated through tax deferral and through eviscerated CFC rules, check the box. This will reinstate the first crack principle, not all the way up to the residence country rate, but at least up to the floor of 15%. This means a movement back towards a worldwide tax system. Now, there sits the UTPR, which Ruth Mason has called a fail-safe mechanism, and it clearly is a fail-safe mechanism. but it gives source jurisdictions access to the multinationals tax base outside their water's edge with no nexus and no transactions connection whatsoever. It ignores the separate entity rules, it ignores the water's edge, it ignores the nexus rules. This is a movement away from the existing international tax regime, all right, and a movement basically to what realists and political science talk about as anarchy. It's a free-for-all for any subsidiaries to basically go after and capture a bit of the profits earned elsewhere in the multinational group, even when it's outside their separate, then it ignores the separate entity rules, outside nexus and outside transactions. Let me mention here, because it's not in the slides, I've been paying a fair amount of attention to substantive consolidation, which are bankruptcy rules. In substantive consolidation, when a multinational goes bankrupt, one of the questions is, what happens to an affiliate that is profitable if the other entities in the multinational group are making losses? Can the ones making losses go after the subsidiary that is making profits? And typically, bankruptcy courts have said no. In other words, the water's edge separate entity rules matter, and they matter in bankruptcy law. But we're having a proposal here from the OECD to ignore those rules in the tax arena. I am very much against this because I think it really moves us away. I also am not sure that it's even necessary. If the IIR and the qualified de minimis minimum top-up tax work, there is no need for the under-tax payment rule. It could be dropped. The fail-safe would not be needed. And I think that's particularly true if we went with a new multilateral instrument that was put in that would enforce this. I therefore think the absence of a multilateral instrument is actually a problem here. That if the MLI were to institute the IIR and the domestic qualified minimum tax and countries signed on to this, you could keep the UTPR, but it would not be needed. All right, let me talk now about tax rates and what that has an impact for FDI location. And here I'm going to move to talk about the lessons coming from this year's World Investment Report that UNCTAD published in June 2022, where the third chapter looks at GLOBE. I want to talk briefly about different kinds of tax rates. We all know what the statutory tax rate is. I said most people know what the average effective tax rate is also, which is simply the total taxes paid in the jurisdiction divided by the profits declared in that jurisdiction. What the World Investment Report does is makes it very clear that from the point of view of attracting foreign direct investment, there's another tax rate we need to look at. And I am going to call it the BEPS effective tax rate, or the better, BETR, the better tax rate. The better tax rate looks at the taxes actually declared in one jurisdiction, all right, in the actual jurisdiction where that profits are declared, but takes account of profit shifting opportunities where the money has been moved out either to investment hubs or to tax havens. So the overall average effective rate is a weighted combination of the profits in a jurisdiction and the profits that have been shifted out to, say, a 0 or a 5% tax location. So the better tax rate, the BEPS effective tax rate, is below the average tax rate and surely below the statutory rate. Typically, the gap between the statutory rate and the average effective rate is driven by tax preferences, right? It's driven by tax holidays, for example, and special economic zones and things like that. But then the next one down takes advantage of profit shifting. Now, I think this has not been understood. And this, for me, has been very important. Let's take some countries with really high statutory rates, like some of the African countries and many Latin American countries, where the rates may be 30, 35, 40%, for example. A country with a very high, say, 35% statutory rate. After tax preferences, maybe it goes to 30%. But it could be that the better tax rate, the BEPS effective tax rate, could be as low as 20, for example, or 10 or 15, depending upon how much profits have actually been shifted out. So in other words, even though the statutory rate's very high, even though the average effective rate taking account of preferences is very high, when a multinational is looking at whether or not to invest in that country, it's paying attention to the fact that it can actually shift profits out into a haven like Mauritius. So an African country that has a tax treaty with Mauritius, for example, could see its better tax rate significantly reduced through transactions with Mauritius, all right? And therefore, foreign direct investment comes in because it's paying attention not to the average effective rate, but to the better tax rate, the BEPS eroded tax rate here. Now, if Globe comes in, those profit shifting opportunities go down. The BEPS effective tax rate rises. What that means is rates are going to rise in countries that otherwise were attracting foreign direct investment because the multinationals realized they could shift the profits out. What this means, and this is what I want to highlight here, locational advantages other than tax, such as an educated workforce, natural resources, Industry 4.0, digital infrastructure, are going to have much more location, economic factors, not tax factors. Political factors such as rule of law are going to have much more impact on FDI location than before. So what that means is the incentives to profit shift, and this is out of the World Investment Report. The orange is the what happens in taking account of the BEPS rate. The green was the effective, the pre-Pillar 2 rates, and what will happen to the post-Pillar 2 shifting. Profit shifting is going to go down, and I want you to notice the drop in Africa, the drop in Latin America, the drop in developing countries, because as that effective tax rate rises, less foreign direct investment will go there. There'll be less profit shifting there. There should be less base erosion and less profit shifting. Implications. Average effective tax rate should be more accurate predictors of foreign direct investment and more likely to affect the scale and location of FDI. Real factors will have more influence. Offshore financial centers and tax havens, they got to go up to 15% too. And so the question is, will they continue to attract inward FDI? And again, that will depend more on their non-tax locational attractions. It also means the first crack principle, which has been effectively dead for many years, now could provide a real source of income for developing countries. But if and only if foreign direct investment stays there. And so what I think this means is economic factors that drive location now matter twice. Once in retaining foreign direct investment, and second, if that new tax revenue that is generated for these developing countries comes, right, how it's used, and whether it's used to fund a more sophisticated, educated workforce, whether it's used to build the infrastructure to create rule of law that continue to attract inward FDI and high value added activities. Let me end by talking about tax preferences. I think source countries are still going to be incentivized to attract FDI by offering preferences, but the problem is the preferences are going to have to change. Globe is going to wipe many of these preferences out because it'll lower the effective rate of Globe tax and therefore increase the top-up tax. The World Investment Reports looked at this too and basically shown that tax holidays and exemptions, special economic zones, one-stop shops are going to be much, much more problematic afterwards. So in other words, every country that has been relying on inward FDI being attracted by tax preferences is going to have to look at those preferences and figure out how to create preferences that attract inward foreign direct investment, but don't affect Globe. This is not going to be easy, and many countries are already locked in by international investment agreements that may generate more ICSID disputes. For example, if a multinational complains that it had a 20-year tax holiday and now the country's tried to take the tax holiday away. So let me end by talking about Hungary. Hungary ranks 7th among the European OECD countries on the Tax Foundation's new International Tax Competitive Index that was just released. In other words, very high. Hungary gives a variety of tax preferences to attract inward FDI and create jobs. I know that Hungary has delayed signing on to Globe because it thinks that Globe should be introduced much more slowly, partly because of the war in Ukraine. I share much of this problem and much of these views. My own view is that we really need a multilateral instrument. I do not like the UTPR, which I think is a movement in the opposite direction, and a movement towards anarchy and much more tax games being played by source countries that have no right to tax that income under existing law. My own preference would be to go back to the drawing board. Maybe one other point, and I'll say here, I find it very highly unlikely that the UTPR is ever going to pass the US Congress, that the US Congress is going to allow source countries where subsidiaries and permanent establishment of US multinationals are located to come over and tax in the United States. So I think this may be dead. The UTPR may also be dead on that reason. I am, however, optimistic in terms of thinking that if we could do this right, if we had a new multilateral instrument, if we did that, if we created in effect a first crack principle up to 15%, it really would benefit developing countries, including Hungary, if done correctly. My real problem is with the UTPR, which I think is not needed. I don't think the fail-safe is needed if we had a multilateral instrument. And I think it's a contradiction of the existing rules. So let me stop here and say thank you very much. And I look forward to your questions. Thank you.
Okay, thank you, Lorraine. I open up for any questions. We have another 5 minutes for a very quick, short Q&A. But don't feel guilty if you don't have any questions, and we're gonna have the slides, and our members know that we can share. But now I keep silence for a couple of seconds.
I know as a guest, it's not very nice to be the first, but I understand your point of view. But coming from a low-tax country, I am always surprised that the OECD was able to sell this whole concept as an anti-tax avoidance matter, while this one actually hits the real operating investments, and therefore I wonder how the OECD handles that part. The substance carve-out is a nice concession, but it's just that, a concession. It really is going against the principle which was expressed by the EU court in the Cadbury-Schweppes case, for example, that the taxpayer has a right to actually pay the most advantageous tax, provided it's a real substance there, provided it's not an artificial structure. So I believe that while this approach has merits, it went much further than the original merits justified.
I think, Gabby, that's a really helpful and useful point. And let me say that if all countries were to adopt CFC rules, I think very good CF rules, that would solve much of the problem. And if the US got rid of check the box, for example, we wouldn't really need this, right? The problem is that under the current system that we have, even taking into account all the BEPS 1 reforms, I think the race to the bottom is still there, the tax competition. So part of the problem is what you're doing is trading off different principles. One of the principles is we want equity and we want neutrality in the system, and we want to encourage investment in the system. But when it's almost like saying the amount of tax competition goes past the optimal amount of tax competition. Judge Learned Hand, for example, said we all have the right to avoid tax according to the law. But you and I know over the last 20 years, the amount of aggressive profit shifting has been way out of control with what you think even Judge Learned Hand might have condoned. So for me, a minimum tax is not the preferential way to go. It's not first best, but I think where we're at, particularly if it was done through an MLI, drop the UTPR, and really did allow, I'm quite happy with allowing a serious substance qualification, right? For real substance, I don't see a problem. But the current proposal is not really that, right? The current proposal is much more focused on domestic countries with very potentially very different rates. I don't think the US is going to sign on because of the UTPR and the way it's structured. The ability for source countries to go after and capture the base from a residence country, to me, seems to be a bridge too far. For me, the key thing is the reinstatement of the first crack principle, which allows developing countries to actually collect tax. I would prefer it were almost higher than 15. In other words, what it will mean is that countries that now can collect a 15% tax can use that money, and they can use it for development, right? There are two ways one attracts inward foreign direct investment. One is by giving tax preferences. But if you give a lot of tax preferences, you don't raise revenue, and therefore you can't focus on your infrastructure and public goods. I think most multinationals really do want strong locational attractive advantages that are based on good public goods, a good infrastructure, good rule of law, an educated workforce, and that those are more important than a reduction in the tax rate and the ability to engage in shifting off to a tax haven. I think either works for here, but my thinking is the preferences, the long run preferences are better satisfied when real economic activity drives location decision. And the minimum tax would move us partly in that way. I don't know if that quite answers your question, but thank you.
I think we can spend a separate hour just on this point, so no. Gabi, you're on mute if you want to say something.
No, thank you. That's quite okay.
Yeah. Okay, thank you, Lorraine. And again, respecting each other.